I believe it was the famous value investor Howard Marks that said, it's not what you buy, it's when you buy it. You can find a fantastic, strong company that is solid in every single way. It fits in your portfolio perfectly. But if the price is just too high, you're not going to make a lot of profit. You're not going to get a lot of gains out of that. You have to wait and be patient until it's beaten down. Conversely, you can find an absolute garbage company that is also beaten down. But if you're just going to jump into it because the price is low, you're not going to make any profit because that price can go even lower. It's always tempting to think, oh, well, this company's gone down 50%, I'm going to buy it. Yeah, but if it's a garbage company, it can go down another 50% and then another 50% after that. So what we're going to look at are, I believe this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 different companies that are beaten down. These are at or near 52-week lows. And we're going to analyze them and see what are they worth, what are they scoring in our inner flame finance scoring method. If you're new to this channel, by the way that we run this channel is we score stocks between -10 and +10. -10 is absolute garbage, +10 is the perfect company, 0 is neutral. And we like to be picky and choosy with our stocks, and so we typically only consider stocks that score 5 or higher. And so I have these 11 companies. We have Stride. This is a learning company. They sell products and educational services to both public and private schools. We have Pinterest, the social media platform. We have Doximity, which is a healthcare stock that I believe handles information in the healthcare sector. Duolingo is an app that teaches people how to learn new languages. And we see a lot of these companies having pretty solid scores. We see, actually, Stride has the only 10 I've ever seen in our scoring method. So we're going to look at Stride and see if the numbers and the intrinsic value actually warrant such a strong score. We also have Paycom. Paycom is in the software space. I believe they handle data analytics for companies. We have Alamo Group. They are in the industrial sector. They handle farm equipment and farm services. We have BMI, Badger. They handle water flow and water meter technology. And then we have MOS. They are materials. Mosaic handles fertilizers for crops. So the others, Liberty, TPL, and Costco, we're not going to look at these through a growth lens. And again, we're looking at these numbers through growth perspectives. Because their scores are so low, maybe they'll redeem themselves in the safety metrics. So let's look at Alamo Group. They have a PEG ratio of 1.2. Remember, we like PEGs under 2. Under 1 is even better. So that PEG is pretty nice and low. They have a nice free cash flow yield at 7.4%. They don't have revenue growth reported, so I couldn't find that number, but we do have EPS growth at 11%. We have Badger. They have no debt to equity. That is fantastic to see. They have a pretty high PEG ratio at 2.4, so that gives us pause for concern. 5-year forward PE at 21.7. That still seems a little bit rich for 5 years out, so that'll be on our brains a little bit. Alamo is a 6.1 and BMI is a 5, so not the highest scoring stocks. Costco, Costco is a fantastic company, but when you look at their PEG ratio at well over 2, well over 3, it's actually over 4 at a 4.1. That gives us some concern. Forward PE at a 40, that's still pretty rich, but Costco always trades rich. If you've ever wanted to buy Costco and you wanted their PE or their forward PE to come down, you've never bought Costco because those numbers just never come down. So sometimes it's worth it to look at a 5-year forward PE. And if you look 5 years out into the future with an anticipated 9.8% EPS growth, you'll see that Costco is pretty close to 30 still. So it is an expensive stock, but when you look at the stock price over the past 15, 20 years, it just keeps going up and up and up. So it's one of those really tricky companies. You rarely get Costco at a discount. We are at 52-week lows, so this might be a chance to buy Costco, but they're only coming in at a growth score of 1.1, so we might hold off on that. Doximity, low debt to equity, that's fantastic. PEG ratio of 1.9. Duolingo, they have fantastic revenue growth and expected EPS growth for the next 5 years. They're coming in at a 5-year forward PE at a 4. That's phenomenal if they can execute on 41% EPS growth. I believe in our analysis we use something more along the lines of 25% EPS growth. So we're not going to use 41% in our intrinsic value analysis. Liberty, The only thing they really have going for them is a pretty solid profit margin. Stride, free cash flow yield of 13.4%. They have a very low PAYC ratio at 0.7 and a very low forward PE at 8.1, and their 5-year forward PE coming in at 5.5, just fantastic. Remember, we like to see those numbers, the lower the better. Mosaic has expected EPS growth of 20.9% with a 5-year forward PE of 2.4. This is really the only solid dividend pair that we have in this list today, so something to consider if you're looking for a little bit of safety. Debt to equity at 0.4, forward PE at 8.9, all good numbers to see. Paycom, PEG ratio, respectable at 1.4, very little debt to equity. Return on invested capital, 21%, that's nice and solid. 5-year forward PE at 11.8, that's great. Pinterest is, there's a reason why it's scoring a 9.4. They have fantastic return on equity at 51%, fantastic return on invested capital at 22%, revenue growth expected to be 12.8%, solid EPS growth expected for the next 5 years, annualized at 18.8%, a 5-year forward PE at 3.8. That is fantastic to see. And the energy company TPL, they're scoring pretty low at 1.7. So we'll just show these numbers to show them, but we're going to move on to the safety scores. Okay. So in terms of safety, we see very similar rankings and similar orderings to these companies. Learn, which is Stride, LRN. Stride is coming in at top at 7.9. Pinterest and Duolingo right behind with Paycom. And when we look at these, we see that so Alamo Group does pay a dividend, 0.7%, so not too fantastic. They are growing their dividends in the past at 15.4%. That's solid. They've grown their dividends 11 years in a row. Fantastic to see. Badger, also not a fantastic dividend yield at 0.9. Dividend growth at a solid 21.3%. They have grown their dividends for 33 consecutive years. So the BMI is a dividend aristocrat. Costco's actually lower their dividends, so we don't want to see that. Dividend growth at negative 74.1%. Payout ratios, by the way, payout ratios of these companies are all pretty decent. We want payout ratios between about 15 to 35%, so everything checks out there. Doximity, no dividend to speak of, so they're going to come in lower on the safety score, but very little debt to equity, so that's fantastic. Duolingo, also no dividend. Very low debt to equity. PE coming in at 22.1. 5-year forward PE again coming in at a 4 if they can execute on that fantastic growth. Liberty, we'll just skip that real quick. Again, they're coming in at a 1.4 for safety scores, so we're not too incredibly impressed with that. Now, Stride, you look at Stride, they have fantastic free cash flow yield at 13.4%, a 5.5 5-year forward PE, return on invested capital and return on assets, fantastic in the mid-teens, debt to equity at 0.4, just a solid company all around. Mosaic has the best PE ratio at 6.2. They have the only single-digit dividend yield at 3.6%. They've grown their dividend 3.5%, and they've only grown it for 1 year. But they do have a 2.4 5-year forward PE, so fantastic. Paycom, it's okay. Dividend yield at 0.8%, hasn't grown it much, if at all. We didn't find any growth for Paycom, but they have grown their dividends for 2 years, so not sure why that metric is missing from our analysis. We have Pinterest coming in, excuse me, return on invested capital and return on assets, 24 in the low to mid 20s, fantastic. Payout ratio 0% because they have no dividend yield, but a solid 5-year forward PE at 3.8. And TPL, again, the worst in the safety play. And you want energy companies that pay dividends. I mean, this is paying a 0.7% dividend yield. You do want energy companies to be higher in the safety space because there's not a lot of room for growth for many of these companies. So those are the scores. That's the scoring methodology that we have. So now what we're going to do is we're going to look at what Wall Street thinks. And at the very end, we're going to look at what we think based on our analysis. So if we focus on the 8 companies that came in with pretty decent scores, we start with Stride, and we see in late October, there's this huge drop. And a lot of times, a huge drop is very attractive to investors. Now, these drops don't come out of nowhere. There's probably something in the stock, in the news coming out about it that makes people panic Sometimes that panic is overblown and it's not really warranted, but sometimes it is. And if we scroll down here through the news, we see that there's some alleged fraud, there's some ghost students for this education company. There's some things that kind of give us pause. And so this would be something that if we were to consider putting this in our portfolio, we might want to do a little bit of digging and see, is there any truth to these allegations? Now, when we look at the forecast, we see that this company is still coming in solid for Wall Street. So Wall Street still considered this a buy. Even the low estimate is coming in at $95 per share, average between 113 and 125, the high estimate at 125. Not a lot of analysts cover this, I don't believe. 4 analysts cover Stride, so one outlier is really going to affect the outcome of these averages, but we do see that Wall Street is somewhat bullish on this company. There's a lot of risk in this company, though. There's a lot of uncertainty with these lawsuits and allegations of fraud, so something to keep in mind if you are considering putting this in your portfolio. Next up, we have Pinterest. Over the past year, they're down 11%. This is something that we did buy around Liberation Day in early April. We saw fantastic gains in Pinterest. We trimmed a little bit in our portfolios. It came down. This might be another opportunity to reallocate our capital into Pinterest. When it comes to a forecast, we see that the consensus on Wall Street is buy. There's an average of about 50% gain over the next year for this stock. Even the low estimate coming in at $30 per share, that would be a 15% return on your investment. So that's fantastic to see. Doximity also down for the year, 17%. We see they are indeed at 52-week lows. Statistically, or rather in the forecast, we see that again, the low estimate coming in at $55 per share, that would be a 24% increase on your money, on your investment rather. Average in the mid 60s, giving you about a 50% increase in your investment over the next year. The high estimate coming in at $90 per share. That would be a doubling of your money, as it is currently at $44 per share. Now, the consensus on Wall Street is just into the buy range. It's not firmly into buy. It's almost in hold. 21 analysts do cover this, and so there are a lot of opinions and a lot of information baked into this, but there are some analysts here that are saying that we need to sell, or they are recommending strong sell for Doximity. So something to keep in mind as we move forward. Duolingo, the language learning app, we see that they are down and they are on a downward trajectory. The question is, are they bottoming out? Do we see any recovery in the future? Forecast for Duolingo, we see that on average, even though it's trading for 175, the average price target for Wall Street over the next year is 317. So that would be between a 70 and 80% return on your investment in Duolingo. Again, the low estimate, the low analyst says that it's 185. That would still be a 5% return. But with the risk of a company like Duolingo, it's a small cap. It's got a lot of competition. It has a very small moat around it. That may not be enough to warrant an investment. But when we look at the average and the median in the 70 and 80% range, that's fantastic. Some analysts think that it's coming in at $500 per share in the next year. That would be almost a tripling of your investment. 185% return. 14 analysts cover this, so something to consider. And we do have one analyst saying to sell the stock, also something to consider. Paycom, down 22% for the year. We see that the overall consensus on Wall Street is buy. Again, very, very shallow into the buy range, almost into the hold. We do see that the average is in the mid 30% gain for this company. The low estimate coming in at 13%, high at 69%. 13 analysts cover Paycom stock, and nobody right now, at least, is saying to sell Paycom. Alma Group down 9% this past year. Analysts are saying that it is a buy. 2 analysts only cover this, and so this is going to affect the averages. I mean, one person can be an outlier. There used to be, it looks like 3 people covering the stock, but one fell off. So one buy, the average coming in at $225, high at $260. The low estimate at $190 would still be a 13% return on your investment. Now, Badger, we are down 18.6% for the year. Analysts are saying that this is a strong buy. So very firmly into buy, not almost, it is into the strong buy. 4 analysts are saying strong buy. 8 analysts cover this overall. We have a low estimate of $205, a high estimate of $264. So even at the low end, you'd be making, if these analysts are correct this year, about 18% on your return. Average analyst consensus, you're going to make in the low to mid 30% on this stock. And we don't see anybody in the sell range for this company, so that's fantastic. And finally, Mosaic, the only real dividend payer. They're pretty much flat for the past year. They're only up 0.37%. The forecast for this company is in the buy range. On average, you're going to make between 37 and 43% if analysts are correct. The low estimate is basically what it is right now, $24 per share. High estimate, $44 per share at 83% return. 14 analysts cover this, and we see that there are no sells for this company. So that's what Wall Street thinks. We're going to take a look at what we think. We're going to run our own intrinsic value calculations and see where we stand on these 8 companies. Before we get into our intrinsic value calculations, I do want to remind you that we have links in the description of this video showing you how to build out your own intrinsic value calculators. So right now there are 3 primary calculators that we've built out, and in the description I have links showing you how to build these step by step in Google Sheets. So you can build these out for yourselves. You can run your own numbers. You can do this for any company you want. You can use your own predictions and projections. And so if you agree with my numbers, if you disagree with what we're doing on this channel, you can do it yourselves, and you can build out your own intrinsic value calculators. There's the PE multiples model that we see here. Pinterest, the intrinsic value for that company would be about $52. That would be a margin of safety of 50%. That's fantastic. There is no dividend discount model because Pinterest does not offer a dividend. So we're not going to include this in our analysis for Pinterest, but again, there's a video in the description showing you how to build out a dividend discount model. And then finally, the discounted cash flow model, also linked in the description of this video, showing you step by step how to build out this intrinsic value calculator. These 3 calculators, these 3 ways of computing intrinsic value are absolutely necessary for the investor to figure out not what is the price of a company, but how much is it worth? What is the value that I'm getting? You want to buy companies that are undervalued so that you can profit. Okay, so let's jump into our numbers. What do we think? So coming in at number 1, average score at 8.95 when we average the growth and the safety scores. The intrinsic value of Stride is $92 per share. It's currently trading for $65 per share. That gives us a margin of safety of 29.4%. We are assuming 5% growth of this company, and we did use a discount rate of 12% because there's a lot of risk baked into this company. So again, this is the company that they've got a lot of lawsuits on the horizon. There's allegations of fraud, so something to consider when investing. Pinterest coming in at an average score of 8.65, currently trading for $26 per share, intrinsically $43 per share. So that would give us a very healthy margin of safety of 40%. Doximity, we are not going to consider Doximity. They do have a score above 5, 6.45. Their price is currently $44 per share. Based on our estimates and projections, they are intrinsically worth $25, so we would be paying a 77% premium. Now for Doximity, what I used was 13% growth and a 12% discount rate because there is inherent risk in this company as well. Duolingo coming in at a solid 7.15 for the average score. Intrinsic value is $275, currently trading for $176. That gives us a 36.2% margin of safety. For Duolingo, we are assuming not the growth rate that's in the stratosphere. I forget what it was, something like 40, 50%. We are using 25% growth for the next 5 years, and we are assuming that the discount rate is 12%, also because Duolingo has a lot of competition. It has a very small moat. So even with those conservative numbers, we're still seeing a 36% margin of safety for Duolingo. Paycom, no margin of safety. You'd be paying a 7.7% premium. Alamo Group, we're paying a 5% premium, currently trading right around its fair value. It's currently trading for $168. We think it's worth $160. If you are interested in Alamo Group, you would want that price to come down quite a bit. BMI, Badger, also something we're going to steer clear of. It's currently trading for $174. Intrinsically, it's worth $119, according to our estimates. And for Badger, we used 9.5% growth for the next 5 years and a discount rate of 9%. Finally, Mosaic. This is coming in at a very solid 62.4% margin of safety. We see that even though they only have an average score of 4.65, and again, we typically prefer scores to be 5 and above, but if you absolutely had to have Mosaic in your portfolio, this is something that you're getting a pretty decent margin of safety. Not the strongest growth company, not the strongest safety company, but a pretty decent margin of safety of 62.4%, currently trading for $24 per share, intrinsically $64. And for Mosaic, we use the 12% growth rate and a 10% discount rate. So anything that we say here is not financial advice. Don't buy, sell, or hold anything based on what we say. Make sure you always do your own homework, always do your own due diligence. I appreciate you watching. Be sure to like this video. Be sure to subscribe to the channel if you got anything out of this. Tell your friends, tell your family, tell your mother-in-law, bring everybody into the Inner Finance investing family. We'd love to have you. Thanks for watching. Happy, healthy 2026, and we'll see you in the next video.